It is 2 o'clock now, so we might make a start. Welcome, everybody, on behalf of Franchize Consultants. Welcome to our session on the 2026 New Zealand Franchise Outlook Survey. We look forward to sharing the results and implications for franchising in New Zealand in the year ahead. Before getting started, I want to start with some quick acknowledgements. The first one is thank you very much for attending the event. We've had a lot of interest from within New Zealand and some from overseas as well, which is great. Secondly, thank you if you contributed your responses to the research. That's what makes this possible and valuable, so thank you for that. And thirdly, I really want to thank in advance Michelle Van Gaalen, Brad Jacobs, Bill Wu, Sally Knight and Daniel Cloete for their contributions a little bit later in this session. I'm going to present for the first 25 minutes or so on the results, and then we're going to hear from our co-presenters in terms of how they're seeing things and the implications. So to begin with, we're going to have some background, then I'm going to run through the results, then the perspectives, and then we'll have a little bit of time at the end for some Q&A. If you've got some questions, please use the chat area there, and we look forward to hopefully being able to answer those for you. Hopefully everyone can see the screen okay. A little bit about the research just to kick things off. This is actually the 14th year that we've been running this research. I wish we'd started it around the GFC, then we'd have that as a comparison, but 14 years of results on the same questions is certainly very useful. The research is focused from a franchisor point of view. What are franchisors seeing? And you might note that we have perspectives from a franchisor on what they're seeing, but we also have a separate group of service providers, so that's consultants, banks, lawyers, accountants, publishers and the like that are involved in franchising on how they see the sector from a franchisor point of view. So you'll see two series there. All are asked for what the views are. Do you expect a particular area, be it general business conditions, to be better, the same or worse in the year ahead? And what we're reporting on is a net difference between those that expect things to get better versus those that expect things to get worse. So if it's positive, it's in general a good thing. It's expected on balance to be better. This year's results that we're presenting are based on 47 franchisor responses, which is good, and 12 service provider respondents. So that's a smaller number that we should, think about in the context of the results. We're going to focus mainly in the session today on the franchisor perspective just due to time, but the report has got both perspectives within it. And then finally, you might note that, by participating in this research, Franchize Consultants donated some money to the causes that we outlined, in particular Salvation Army and Women's Refuge, but also you had an opportunity to choose your own charity, and there were 8 other charities selected that also benefited from this research, which is great. Okay, well, without further ado, let's get into the results and to the sentiment levels. And first cab off the rank is looking at general business conditions. And for different business confidence surveys, this is really the leading questions. How do you expect conditions to be in the year ahead? And you can see there that franchisors very positive. It's a net 68%. It's almost as high as it has been. It's more positive than last year, and you might say compared to last year that it's what we expected would happen last year, but things certainly came off, whereas this year I think franchisors are starting to feel it happening, which is stronger. And certainly for people that would have been on the Franchise Association webinar with the senior economist from Westpac, Satish Ranchod, a couple of days ago, you would have seen some of the things that we might say would be underpinning the positivity in this area. So things like, lower OCR, interest rates, some of the mortgage fixing starting to roll through, stronger commodity prices, unemployment easing, net migration starting to turn the corner. So confidence generally starting to improve and consumption growth starting to happen again in some of the more discretionary areas. Service providers here, you can see, are even more positive than franchisors here, but a positive picture overall, which hopefully portends to a good year ahead in general. This slide here we have to show how do franchisor views compared to business owners generally. If we think about the ANZ's business confidence survey, which has been going from near the start, and the New Zealand Institute of Economic Research's survey, and you can see that there's a very close correlation between what franchisors expect in the year ahead to owners within those other surveys as well. Although you can see that franchisors in general just a little bit more positive than general owners, and at least sort of 80% of the time, you might say. Excuse me. When we think about the ease of finding franchisees, we are in positive territory, and I think when you look at the series, it's about as positive as it has been on net. So it's a net 24%. Expect things to improve there compared to 26% last year. So really the same kind of level overall. So quite positive on balance. Not hugely positive, but quite positive on balance. And then when it comes to obtaining finance for franchisees, which is a key growth driver, as you would know, it's a driver or it's a constraint depending on which way around that you look. It is in positive territory again. It's a little bit less positive overall compared to last year. So it was 19% last year, 15% this year. Service providers, though, you can see have really bounced back on that one. From their perspective, from a franchisor point of view, it's more than 60%. And one other leading economist in New Zealand once asked me if I thought that service provider view was a leading indicator, and let's hope it is in this particular instance. Finding suitable sites for those where sites are important, that seems to bounce along in similar areas overall, but it's a net 16% for franchisors, slightly less than last year, but that could be almost a single result difference. I guess what we would say there is it's really going to depend on different areas, but if we use Newmarket, where our office is as a little bit of a case study, the high street is actually starting to build out very slowly again, and I wonder if that's a sign of things for other areas as well, as this confidence starts to, and the engine starts to get moving again. Finding staff, that has been very tough through different parts of the years and the economic cycle, you might say. On balance, it's a little bit less positive, a net 9% compared to net 24% last year, but still in positive territory overall. And it hasn't been in positive territory for too many of those 14 years. So I think on balance, we're positive overall, but we know that we're going to be competing for staff for sure. And that's finding suitable staff. So, finding quality staff. And then we move into three different dimensions that are really important from the franchisee standpoint that, of course, flow through to actually impact group results. And we know sustainability at the franchisee level is absolutely crucial. So what do we see there in terms of top line sales for franchisees, franchisee operating costs, and franchisee profitability? You can see there that we have got high expectations for a better environment for franchisee top line sales. Franchisors reporting a net 66% compared to 69% last year, so still very positive, but this year we expect that actually really would happen, and service providers even more confident about that by comparison as well. So that is a very strong outlook from franchisors there. Operating costs, however, continues to be, identified tough area with inflationary pressures continuing to be sustained. So you can see there net negative 38%. So, on balance, the majority expecting things to get tougher in terms of franchisee operating costs. So this clearly is, a key area of, or needs to be a key area of focus for franchisors and franchisees in the year ahead. And how does that flow through in terms of franchisee profitability or expectations for franchisee profitability? Do we expect them to get better, the same, or worse? And on balance, we expect things to get slightly better. We're at a net 6% positive compared to 12% last year, so it is good that it's in positive territory. However, of course, we'd love that to be climbing up. And I think, we do expect sales to get better, but how much better will they get this year? We know operating costs are going to be inflationary, so maybe on balance we expect a little bit, but not a lot. But let's hope that this is sort of the beginning of better things to come as we move through the year and into then to 2027. And then if we look at sort of the bigger picture from a franchisor standpoint, how are we finding things? Sorry, I'm just doing a quick double check to make sure I'll let everyone in. Excuse me for a second. I think everyone is in the session, which is good. How are we looking at franchisor growth prospects? So we're almost as positive as we've ever been. So a net 66% expect franchisor growth prospects to be better, and you can see that service provider perspective is even more positive as well overall. So that is a much more optimistic picture than last year, and certainly the previous years rolling back from there. So that's very positive overall. We then move through to look at sentiment within the sectors, and when you see the reports, I'll be making that available later this afternoon. You can read this in more detail, but certainly different sectors have been impacted in different ways for sure. Some are experiencing strong activity, some are improving, and some are still finding it very tough. If we're to highlight some of those sectors that are more positive, then certainly if we think about the trades, property improvement and handyman areas, it is one of the most positive areas in terms of sentiment. Automotive repairs also very positive from the respondents, and areas like construction and home building, it's improving activity, starting to pick up, starting to feel more confident. Tougher areas in terms of feeling still at the moment: hospitality, retail in general, home retail, areas of that sort of more discretionary spend, including some durables, and particularly around commercial services, particularly competitive still, and a lot of latent pricing pressure. Moving on to the next slide, we also asked about what do you see as key challenges to your franchise system development in the year ahead, and also what do you see as the key opportunity for development in the year ahead. And if we think about challenges to development for 2026, the three big ones: one is finding suitable franchisees, and you can see some of the illustrative comments there. The second one certainly is around economic uncertainty and pressures, and then the third around access to finance and borrowing costs. And then going down a level from there, 23% of respondents identify those existing franchisees in the network in terms of their level of performance as one of the big challenges for the year ahead. Then competition and price pressure, regulation, legislation and political environment, cost pressure and inflation, and then capability and leadership fatigue. And this is a really interesting and important one, and one of the first times this has really come up, and we can understand why. We'll talk about it a little bit more, but certainly we all understand that increasingly we're in an environment where we've had a prolonged tough period, but we also have so many forces that that will require us to think about how we adapt our systems and take franchisees on a change journey. And that's not easy to do in a franchise system. So we'll talk more on that shortly. And then we've got a little slide here just showing the difference. And again, we can look at the report when you see it. But essentially, finding franchisees, a tough economy, and access to finance are identified as the three key challenging areas. And that's exactly the same order as 2025. And you can see from 2021 going through just a bit of a different order there, and obviously COVID during those years and finding staff and finance and things more prominent, back earlier 5 years ago. Then if we look more positively, what do we see as key opportunities for franchise system development in the year ahead? Almost a third or just over a third really focusing in on the economic recovery and the return of confidence and that consumer spend. And then second, around technology, AI and digital transformation. So that's really seen by over a quarter of systems that responded as being really the key opportunity for development for them in the year ahead. And then other key factors there around network expansion through other forms, franchise recruitment and resales opportunity, and then access to capital and improved lending. And it's really nice to see that coming through. That's probably the first time that has come through as an opportunity in a number of areas. So hopefully that means that access to capital is actually on the improve, and we're already starting to feel that. We're also focused again this year on asking our New Zealand franchisors what they see out of this list of key trends impacting franchising and other businesses as really important to their franchising business models over the next 5 to 10 years. So what areas do they see as most impactful, and therefore in turn most likely to really need to take seriously, really need to understand and potentially adapt our franchise system and model to. So in terms of what do we see as most critical, 4 key big ones this year are around economic pressures. So almost 3/4 of franchisors responding identify that as essentially a mega trend impacting their models for the next 5 to 10 years. So one to take very seriously. Second, almost 2/3 digital transformation. And third, related in a way really, is marketing evolution, which we'll talk about shortly, and then workforce challenges. So those are certainly the biggies, and then things dropped off from there. I have a slide here. It'll be easier, for you to look at and read in the report, where we identify, those 4 key megatrends. What are really the implications from a franchisor and a franchisee perspective? And certainly, if we think about economic pressures from a franchisor point of view, it's really going to be about protecting unit economics and thinking about supply structures, cost control, smarter pricing frameworks, clearer financial guidance. From a franchisee point of view, it's about operating with greater commercial discipline, focusing on margins, waste, labor efficiency, and pricing execution, by way of example. If it's around digital transformation, it's around really seeing the opportunity. Here we know digital transformation can relate to all areas of your value chain, so many different areas, really understanding which areas are going to be most impactful that you adopt. And from a franchisee point of view, we really need our operators to fully utilize these systems and tools so that we can get that network effect of everyone on board. From a market evolution point of view, again, there's so many opportunities here that are coming through, particularly with technology, and embracing those, finding those that are most critical to the business for you, and then getting that engagement from franchisees actively, knowing that this is often an area that is turned off within many franchisee businesses, and we need it turned on. And then workforce challenges, recognising that we're in a competitive market, the nature of workforce is changing. How do we make sure that our models allow for more resilience at the local level? And then how do we get our franchisees, focused on retention and models that allow them to open effectively with, a more reliable and a very efficient workforce. And all of that really, fundamentally is going to involve a lot of working together from a franchisor and franchisee point of view to address this changing landscape. And that really underpins why, we have some of the strategic implications that we're going to look at in a second. So then finally, from me, and we're going to hear from co-presenters in a second, what are some of the key strategic priorities there for 2026? And I'm just going to outline sort of 6 here that I believe are really important for the year ahead, given what we can see here within the results and with the outlook and all of the trends that we've been looking at. The first one, which really should always be at the top of the list, is protecting unit level economics. So really understanding and finding ways to improve franchisee returns and our business models potential return. So that is critical in this environment. We know that the economy and economic pressures are seen as that key mega trend, and this is where it comes home. So having real strength here is going to be crucial. The second one is around prioritizing quality over quantity in terms of franchisee recruitment and candidates. They're absolutely crucial. If we want to have resilience at the unit level in terms of unit economics, we need to have operators that are highly capable. And we know from a franchisor's point of view, if you have a network of franchisees that are capable of doing 10% more, let's say, than less, it could be more than double the returns from a franchisor point of view. Just crucial from a unit level sustainability and return standpoint, but also a network level return standpoint as well. Third thing is certainly embracing technology, and you don't need me to go on about that here, but seeing it as a point of advantage, but really taking hold of that area and making really great decisions and working out how we can best work with franchisees for our system. The fourth thing is around the real fundamentals in terms of group standards, but also transparency when we think about operations, performance, full transparency from a franchisor point of view of franchisee activity and performance, but also franchise at franchisee level, so that there's real learning opportunities all of the way around there. That is going to be absolutely crucial as we move forward and look for ways to adapt and improve. The fifth point there is around the criticality of system change. I've always reflected back, in fact, sort of 20 years ago when I started, it's actually a little bit longer than that. I always feel funny talking about planning frameworks and business strategy and SWOT and PESTLE matrices and things. I'm thinking, it feels like classroom, into the boardroom. But today, 15 years ago, 10 years ago, these things are all on the table now. If we talk about these mega trends, they are so impactful. There's so many different areas. There's so much to think about. We actually really do need to be strategic about those now and think about how do we change and adapt. And this is such a key differentiator for franchise systems. So, being clear about what changes we need to make and how we're going to implement those is absolutely crucial. And the courses that we run, we actually have topics on those for field managers because they're always an agent for change. But from a franchise or management standpoint, also in our managing franchise system, it's always been there because it's so crucial. It's tougher in a franchise business, obviously, to make changes than it is in a company-owned operation. And then the final point, the sixth point, really is around sustaining that leadership capacity. For all of the owners and operators here that have, might have been around for the GFC, it was a very tough, demoralizing time. And then we had a sort of a great period of development that flowed after a few years coming out of that. But then, of course, we had COVID, and then we've had the recent tough time. It's been, very, very challenging on energy and on performance. And we're in this area of high change. Again, we're actually the level of well-being and health within our leadership team and our wider teams is absolutely crucial to carry us through to success. So we put this down as a key priority now too, because it's just, believe it, is so valuable going forward. Look, that's enough from me for now. So that's my point of view, key results, what are we seeing, a little bit of the interpretation of that, what does that mean in terms of strategic priorities. Now, let's get into our co-presenters and let's get their perspective on how they're seeing things at the moment. Can I just check in, Michelle, are you with us on the call at the moment?
I am, Callum.
Oh, fabulous. Thank you, Michelle. I can't see you there, but hopefully, here we are. I can see you there now. Thank you very much, Michelle. Michelle, can I ask you to kick off? Can you give me your sense of what you think about the results? How does that correlate? But also perhaps what's a key trend that you're dealing with or adapting with at the moment?
Yeah, thanks, Callum. Look, I think there's some really good stuff in the survey, and so thank you so much for ATHIS and helping facilitate it. I mean, if you go back to just for people that might not know what our businesses do, we've got two franchise businesses, being Laser Electrical and Plumbing, and Exceed, which is window and door homeware maintenance. So to Callum's earlier point about the industries that are looking up, and the third one is Smith & Smith, which is an auto glass, so vehicle. So in terms of Callum's comments about which industries are looking up, I would say that's kind of right for us. We're seeing much stronger results coming through in all our businesses, but more probably still in the B2C than the B2B space, to be honest. I think the B2B people are still a little bit more reticent about investing and spending more than they need to, whereas we've seen a bit more recovery in B2C, so that's more in the Exceed and Smith & Smith businesses. So I think, we've had a positive start to 2026, which is nice because the last couple of years haven't been that great. In terms of other trends within that, definitely the recruitment of franchise owners and skilled workers. So we've got, the laser plumbing electrical, that's a qualified trade. It takes 6 years for a plumber to complete apprenticeship, about 5 years for an electrician. So they're very, very long run cycles. And we haven't had a lot of investment from a sort of government perspective although it's been coming, but it takes a long time to fill that pipeline. And we're short in New Zealand by a couple of thousand plumbers and probably a couple of thousand electricians. So that's a real problem for our people is gaining and holding skilled workers, less so in Exceed because it's kind of a semi-qualified trade. But finding franchise owners, and I think it's been a little bit easier in the last year or so, as often it is in franchising in an environment where people are being made redundant and they're looking for other ways to sort of other lifestyles, but with less risk. And as we know, franchising provides you with a lot more support than if you went into business on yourself. I think it's the big challenge that we talk to our teams about all the time, or our franchise owners and members, is look for the right people versus any people. So the cost of poor recruitment is much greater than the cost of waiting. And when you're flat out, I was talking to one franchise owner in Exceed the other day, he's fully booked through to March already, right? So he's kind of like, I just need anyone. And I'm going, no, but you don't need anyone because you'll pay for that in 6 months. You need the right person. So I think that's the balance as the market recovers is how do you kind of start your recruitment in a way that gives you time to find the right person rather than finding yourself in a situation where you have to have anyone. And I think that is, one of the big sort of, it's one of the biggest risks and one of the big opportunities for franchising, particularly in our business where it's not like we don't advertise and they turn up and they rock up to the doors, right? We're not like a McDonald's where you can pretty much guarantee that if you give me the big yellow arch and you open the doors and you advertise, you'll get business. So our franchise owners and members still have to grow their businesses. And so, in fact, one of our constraints to growth is the appetite of our franchise owners to move past the beach, batch and BMW mentality and into a real growth phase. And so that's a real focus for us, is making sure we have franchise owners that have the right sentiment and the right approach to growth going forward. Technology, I think AI, we've kind of identified that AI we think is one of our key future differentiators from a franchise value proposition. It's one of those things that we can provide real value to our franchise owners and members in that they would struggle to invest in on their own, and we don't really want. We've got 135 franchise businesses within our two businesses. We don't want 135 of them developing the same tools. We're better off to do that for them and help them be more efficient. So definitely that long-term trend about technology and digital and AI is where we're really focusing. So working on how do we invest once to benefit them all versus them all doing it themselves. That's a key kind of theme for us. I think the other long-term focus that I didn't see in the report, and it might just be that I've got the advantage of being involved in things like the Franchise Association Regulatory and Advocacy Committee, but also in our other businesses, is I think one of the long-term sort of things we have to keep an eye on is the regulatory risks and opportunities that come our way. It's very easy for us to forget that franchising is different and a franchising system is different, and that we do need to keep an eye on ensuring that some of those sort of long-term regulatory trends, like, for example, we're looking at the modern slavery bill at the moment, which looks like will be okay, but ensuring that someone's not creating legislation that treats the franchisor as like the corporate owner versus actually, a franchise system. So I think that's the other thing I'd probably pull out. Callum, I think the other thing we're just looking at is, to your earlier point, is we're having a really good look at ensuring that the balance is right between franchisee and franchisor profits, because we are seeing that pressure come on in the last couple of years around margins for both us and the franchisees. So that's a kind of a real focus for us as well.
Brilliant. Thank you very much, Michelle. So many points within there.
Sorry, too many.
No. And it was spot on. Thank you. It resonated with so many different parts, but also just your unique perspective there. And in terms of regulatory pressures, that is there. If I just quickly nip back, so 36% of franchisors identifying that as an area of impact. So yeah, it certainly is one of the strong ones there, identified by many as well, which is important. I was going to say it was good, but it's not good, because things are moving in ways that make the cost of business higher, but also more complex. Taking more management time away from things like innovation. So hey, thank you very much, Michelle. I know that we could deep dive into that so much more, and your perspective is so valuable. Thank you. Thanks, Michelle. And thank you for introducing yourself there too, because I didn't properly. So thanks, Michelle. Let's move now to Brad Jacobs of the Coffee Club. Brad, are you happy to give your perspective?
Yes, no problem at all. Hi, everyone. I think everyone probably knows the Coffee Club and myself, so I probably don't need to do a big introduction. But yeah, look, I guess probably the first thing I'd say is, it's interesting, service providers generally have been a little bit more positive than franchisors across most of the categories and just in general. So probably not too surprising. I guess maybe franchisors are always just a little bit more hesitant. But I think I made this comment last year. It is quite nice when you look at the franchisor line and you compare it against the ANZ survey and the NZIER survey. Generally, we think in line with regular business owners. So I think I made that comment last year, when we're not sort of some weirdos with two heads. We are just sort of pretty normal people, hopefully. So yeah, I guess there's a few areas where you can see service providers have really jumped up quite significantly, much more than franchisors. Particularly obtaining finance. So that was quite nice to see. Hopefully, those service providers that are answering that are bankers, and so they're seeing that the money's going to be flowing this year, which is good. But overall, there wasn't any that really stood out to me as massively incorrect, so to speak, from my perspective, or massively against what I thought. Probably the one that doesn't really align with the Coffee Club is there was a fairly significant drop again in finding staff. Fortunately, we're not really seeing that in the Coffee Club at the moment. Employment for our franchisees over the last probably year and a half has got significantly better. and isn't an issue for that franchisees are raising with our team, particularly our operations team at this point in time. So that's probably the only one that stood out as something that's not totally in line with the coffee club. Franchisee operating costs. I guess it's it's sitting in the negative constantly, and it has for 13 years from the franchisor perspective. The only time it's ever been positive for 1 or 2 years was with service providers. I guess I kind of see that as a bit of a double-edged sword. It's great that franchisors are constantly concerned about franchisees' operating costs, and as we should be, we're always thinking about how to make our franchisees' businesses more profitable. But it's probably concerning to see that it has got stuck the last 3 to 5 years at a reasonably low level. So there hasn't been any super improvement in that, but the fact that we're concerned about it and hopefully taking action, I guess, is the positive from it. So challenges to development. I think you made that comment that, obviously the top three held from last year, finding franchisees, the economy and finance. And of course, finding suitable franchisees has now been in there for 5 years in a row. And probably the only reason it wasn't in there in 2021 is because of COVID and no one was even thinking about growing. So it definitely is a problem. And from, not just within the coffee club, but I think from lots of franchisors I talk to across many of the different industries, whether it's home service, business to business, food and beverage, whatever it might be, it seems to be an issue for everyone. So it definitely doesn't look like it's let up at all. So I'm not quite sure what the answer is there. It feels like we're regularly all fishing in a fairly shallow pond and working hard to get good franchisees, and probably in some ways stealing from each other, even if we're not direct competitors in terms of what we do. Megatrends. Look, the top two are probably the top two for the coffee club as well. Economic pressures. That is still top of mind for us, and just making sure that we're doing what we can to keep our franchisees' businesses as profitable as possible. Food inflation cost is running high, as anyone who eats knows. Food is expensive, unfortunately, and the reality is we just can't pass it all on to the end customer. We've had to absorb some. And then of course, things like utility costs, insurance costs, all those kind of things as well have been tough for franchisees over the last couple of years. So, yep, those economic pressures are definitely there. And then second, the digital transformation. Yes, that continues to be a big area of focus within our business. Our IT team has gone from 1 to 3 just in the last 2 years, and with more IT and digital transformation that takes place in our stores, the more problems that come with that, the more data that comes with that you can use, the more data that you can get yourself bogged down in as well. And that concerns me sometimes, that we don't flood franchisees with data that they can sit themselves down in front of a dashboard for hours on end and lose track of what they're supposed to be doing, which is making customers happy. So I think there's a balance there of how much we do, how much we share with franchisees, and what you can actually use positively to grow your business. Just I guess a general update on the coffee club. We run a calendar year, so we're 7.5 weeks into our year. We're running double-digit like-for-like growth at the moment. So we've had a great start to the year, and that's coming really equally from both transaction count and average spend, which is really good. We did finish 2025 positive, just only a couple of percent positive on a like-for-like basis, but it really all came from spend, and our transaction count was completely flat. So you can't continue to grow simply by putting prices up. So the fact that this first 7-8 weeks of the year we're seeing equal growth from both transaction count and spend is really positive. I have to be honest, the poor weather over the long weekend periods was pretty good for us, to be fair. So it keeps people in the big malls and keeps people in cafes, which is nice. But the other thing too that we're seeing, so as well as having sort of double-digit like-for-like growth, we're having a double-digit reduction in our discounting. So for us, the less discounting we're doing to get people in the door is better, and of course that flows straight through to margin for franchisees. So the fact that we've started off the year with very little discounting is good, because this is the time of year when sometimes it goes a bit flat, and we will put some promotions out there to pull people in. So that's positive for franchisees in terms of, obviously food costs, number one, because you're selling everything for as close to full price as possible. But of course it flows through to every other general operating expense as well, from utilities to labour costs to rent, all those kind of things. So yeah, that's kind of a wrap up.
Thank you very much, Brad. And you covered so many areas there, which is marvelous, and really delighted to hear that you're experiencing double-digit growth on last year, both transactions and average spend. And I think if we went back to the session on Tuesday and some of the levers in the economy, but also looking forward, hopefully we're only just starting to see some of the things underpinning that, Brad, which mean that might even accelerate further as you go through the year, or certainly into 2027, which would be absolutely
Would be lovely.
marvelous. Yeah, that's right. So thanks again, Brad. Let's now hear from Bill Wu, Director of Paramount Services, and so a different industry again, with commercial and home services. Bill, are you happy to offer your perspective?
Oh, yes, Callum. Hey, good afternoon, everybody. Thank you, Callum, for sharing that survey. Clearly, there's a lot of effort that has been going into it. I would like to just comment on 3 points. The first one is the economic pressure. The report identifies the economic pressures is getting improved, and we certainly share that cautious optimism. However, we still see the economic pressure remains very real, especially in our industry. A clear trend we can see in our industry is our competitors is dropping prices to the extent is unsustainable just to win the contract. Give you an example is in one tender I heard the incumbent price is 6 million, but the incoming contractor's price is 4 million. So this is a cutthroat industry at the moment. The pricing pressure is huge. And in a few tenders we participated, we were told our price is too high. But we have decided to hold our price just to protect our franchisees' interests, our units. Really, our business is not like other franchise model. Paramount goes out to win the contract, then sell it to our franchisees. It's absolutely important. We need to make sure our franchise units are profitable. If franchise unit is not profitable, it is not a healthy systems. So we have decided to hold the price at the expense of a slower growth, which we believe is the right thing to do to protect the system. Is not about short-term growth, it's about long-term sustainability. So that's a stand we deliberately took, and we do see those companies going into a very low price would not be sustainable, and their reputation will be damaged. The second point I would like to comment on is the digital transformation, which resonate with Brad or Michelle. It's definitely a major trend. You probably know we have been investing in our own software. The investment is now well into 7 figures. I have never heard actually in our industry other company have in-house software engineers, but we do. But we found it's actually one of the best strategic decision we have made, because it proves to be a competitive advantage for us to win the contract. In one of the major banks tender, we were told our system is a showstopper. So they definitely worth investing. This is a must and not an optional. And the third comment I would like to make is on the franchise recruitment, because the report identify this is a top constraints for growth. It's interestingly, this is not the case in our industry. I believe this is a industry phenomenon. We actually have a high demand from prospect franchisees, actually a long waiting list. So our problem is chose the right one. So with that long waiting list, we have been able to a bit more selective. So we introduced a preliminary franchise process. During that process, the franchisee still need to sign an agreement with us and pay the training fees. And during the first 3 months, we will provide training and connect with them and to see if they are suitable with us. And they can find if Paramount is suitable for them as well. So at the end of the 3 months, if they decided not to go ahead, we refund them the 100% the training fees. And we can pull the plug as well. So that way we can make sure the capability is tested and the cultural fit is aligned. It's very important. It's not everybody come with the money is good for us. We need to have a group of franchisee has a mind willing to be humble, to service with a service heart. So this is our selection criteria. So to summary, I got 3 points to make. Economic pressures remains, but we are cautiously optimistic. And the digital transformation is a must. Definitely need to go there, especially with the AI development. We have seen extraordinary AI development. We're currently actually looking at linking the AI tools with our software. And the third one is the franchise recruitment. Yeah, we do have a special case. They're probably pretty unique. Okay, thank you, Callum.
Brilliant. Thank you very much, Bill. Yeah. Much appreciated. And I think it's Daniel too often reminds me that yes, a sector might be, in some cases doing it tough, but there are always operators within some industries that are going against the trend and maybe flourishing. Yeah. So, a good example of that. Thanks, Bill. Let's move on to finance now, and Daniel Cloete from Westpac. Are you happy to comment on what you see there in terms of access to finance as a challenge, potentially on the improve? What are you seeing, and what would you say for franchisors?
Yes, thank you, Callum, and thank you, Bill. You guys are always going well. You had some great growth, I think, of sustainability initiatives you did as well. So I have to congratulate you on that. So just a few things. Firstly, we had a great overview by Satish Ranchot, our senior economist, on the Knowledge Builder webinar on Tuesday that Callum mentioned. And he basically addressed most of the drivers that our franchisor customers normally look at when they sort of do the strategic planning for the year. So if there's anybody who wants to look at it, I believe it is available online. But if otherwise, just let me know and I'll send you the slides so you can use some of that in your own sessions. I have to say to Callum, thank you very much for this series that I've seen improve over the years, and especially the quality and the clarity of the takeouts, I think has improved quite a lot over the years. So thank you for all those takeouts, Callum. I think it's very useful to everybody in the industry. So, couple of things. Our job really is on the funding side. Our job is really to support our customers that wants to get into business and to do it at reasonable rates. And given that banks are not equity investors, the answer to that is probably the business are profitable. We can and want to support the businesses and fund it. Franchisors specifically can do a lot to support the growth of these systems by firstly tweaking their profitability models, which quite a few people referred to today, and then also making some sensible benchmark information available to the banks that allow them to fund new prospective franchisees coming into the system. So, you know, that's important, and we're obviously happy to always talk about that. So I just want to make a few quick observations from the market that we're seeing at the moment. So the first one, I have to acknowledge, a lot of our SME customers really experienced some cost pressures and cash flow issues over the last year, and it has been quite tough out there. So we can't get away from that. What I'm seeing at the moment is that franchise systems with strong, well-capitalized franchisees tend to do better at the moment. And sort of outside of the normal business resales, which we're funding a few at the moment, we've also funded a lot of reimages and refurbishments during the last 6 months of last year. And that trend is definitely continuing at the moment. So we've seen some franchisors increasing market penetration at the moment by offering opportunities, sometimes at favorable terms, to existing franchisees to add additional outlets. And we find that we can normally fund those at the moment. So franchisors is coming up with all sorts of innovative ways of getting the systems growing. And, you know, that's been pretty good. So in general, I have to say, I can't always speak for the whole sector, but I think most banks would be more than happy to fund profitable businesses. And I have to say, although I might not be totally as positive as all of those service providers that you had, Callum, I have to say our economists seem to agree with them. You know, it's been a pretty good review from that. And as far as trends going forward, especially disposable income. So that's probably enough from me. Back to you, Callum.
Brilliant. Thank you, Daniel. Much appreciated. And there might be some room for a question shortly. And Stuart, I see your question in the chat. We'll come to that shortly as well. Sally from Franchise New Zealand, thank you very much as well for being with us. Can you offer us a little bit of an insight into franchisee lead generation and recruitment?
Thanks, Callum. But I'm not sure I can add a great deal to what's been said already. There's been a really, really good breadth of different sort of perspectives on this, and different people having different experiences depending on the sector that they're in is important to remember as well, because there have, you know, I can concur, we've seen a huge number of people coming through looking for cleaning businesses. So for, you know, from Bill's perspective, I can understand that he would have that waiting list going. Really good to hear also in the trades, which is the sector that seems to be reviving fastest in the economy, that they're doing reasonably well with bringing some quality franchisees in as well. But and that's probably the big thing I just want to sort of remind you that you've heard already, but to stress it as well, is that it is really, really important to look at that quality. I think Callum's expressed it as recruitment discipline rather than speed. And you know, there's been some points about some sectors are starting to look at expanding with multi-unit franchisees, for instance. So sometimes that's looking into your own systems, but sometimes it's thinking about the person that you're bringing on having the capacity to be able to manage that kind of ownership eventually. And again, that comes down to quality and the specific aspects of the skills that you're going to require from the franchisee, and right from the get-go. And sometimes that's teachable, but usually you know what it is that you need in attitude and in some financial nous and things like that to manage, for somebody to be able to move forward into that kind of ownership capacity. the other comment that was made was fishing in a shallow pond. I mean, across the entire 30 years I've been involved with Franchise New Zealand, I don't think I've ever heard very many people, apart from Bill in this instance, say that there's just so many franchisees they don't know what to do with them all. And it continues to be an issue. And I think even though we have traditionally seen more opportunity come through when employment is higher, there hasn't been this time round quite the same jump from people to head into business, but that might be starting to change. We have seen over the last probably 3 to 4 months quite a lift in the number of people looking for magazines and coming onto our website and starting to actively investigate businesses. So for me, that's an indicator usually that they're at the start of a journey, and you've probably heard me say that before and heard Simon say it in past years as well. There's a bit of a way to go from where we start to see the activity to where it can translate into a business purchase decision. So keep focusing on what you can do to support people towards making that. Tell us if there's anything you want us to be getting out to the market and information and education, and we'll try and make sure that we back you up on that, and the association does the same thing as well. So I think I mean, again, re-emphasize what Michelle said, that the cost of poor recruitment is always greater than waiting for the right person. So just make sure you know exactly who that right person is that you need, and don't compromise on the qualities that are going to make a really great franchisee stand out.
Brilliant. Thank you very much, Sally, and thank you, Michelle, Brad, Bill, and Daniel as well. Much appreciated. We're nudging 3 o'clock. We all like to be on time and know that people have got appointments and things. So I might just quickly, a couple of questions there. One is from Stuart Gurman. Thank you, Stuart. Do Brad, Michelle, and Bill find that the quality of franchisees is now better than 2 or 3 years ago? Could we have one of our franchisor panel respond to that? Has the quality improved in the last 2 or 3 years, or better now than 2 or 3 years ago? Maybe Bill, do you want to? I mean, you've got choice now. You say you've got a list.
Yeah, I can.
So just quickly,
I certainly see that. I think it probably a lot of our prospect franchisees coming from people being redundant. They actually holding a really good position in their previous job. Usually, our prospect franchisees caliber may not be that high, but certainly we can see all sorts of different positions, different people holding a much better positions because you're coming to applying our franchises.
Yep. Thanks. Well, how about for you, Michelle?
Yeah, we're probably, I'm just reflecting on that. So we're probably a bit mixed. I mean, our laser business, you kind of need to be a qualified plumber or electrician really to run that. Although we have started to see people who have business backgrounds come in and buying the larger ones now and recruiting the right people. So that's been an interesting kind of move for us, which is working out quite well actually. And yeah, we've started to see some really quality candidates come through in the last year in the Exceed business as well. So I think it's a combination of people have talked about. There's people on the market who are looking for a different lifestyle. Whether we're getting better at recruitment or marketing, I think it'd be a combination of things.
Brilliant. Thanks, Michelle. We've got one more question too, and it's from Tristan. Tristan Will. Sorry, I'm going to argue because I'm working out which way to go with it. It's a long question, Tristan. Tristan from BDO. Thanks, Tristan, and from accountants and business advisors. And of course, you are going to be laser focused on pricing power, because price can have a massive impact on profitability if transactions and basket size stay constant. So who would like to comment? Bill, you've already mentioned, so I might ask Michelle on this, around your attitude towards potential pricing power in 2026 and the ability to get some more margin there.
Yeah, it's a tough market. What we're competing against is really cheap overseas imports. So it's reaffirming to our customers and to our franchise owners that we're quality brands, and we want to be at that end of the market. But it is tough when they're competing against people that are buying on Temu, etc. for stuff, and go, well, I can get this for this price. Why is it costing me this? So there is constant price pressure. I mean, I think where we're trying to shift our focus on it is for higher value, because we have quite a range of orders or job sizes. And so what we're trying to say is actually the larger the job, go more for profit at a dollar level rather than profit as a percentage. So, make sure that as a franchise owner, you're thinking about the overall value that you can get from a job, not just the GMM or the GM percentage. So we're trying to do a lot of education around how do you manage that price pressure in different ways. Does that?
Yep, no, that's
help?
perfect. Thanks, Michelle. Much appreciated. I wanted to thank everyone now too. Certainly all the co-presenters. Thank you very much, Michelle, Brad, Bill, Daniel, and Sally once again. And thank you everyone for attending this session, your interest in it, and the questions. Really appreciate that. We're now just a bit after 3, so that kind of is the end time. Wishing everyone great trading in 2026, and look forward to seeing you during the year. Thanks once again, and bye for now.